Hi everyone, welcome to True Corporate Business Solutions. We give you solutions. Right, so I want to talk about International Accounting Standard number 36, the impairment of assets. Impairment of assets. Yes, sir. So what you have to understand is, normally we have IAS 16 PPE, the property, plant and equipment, property that's land or building, plant and equipment, right? So normally under IAS 16 will be saying these assets that are held by an entity for use in the production of goods or services or rental to others for administrative purposes, right? So under IAS 16 will be holding this asset for a long period of time. They're expected to last for more than a year. That's what you have to understand. But what do we do in accounting? Remember, we do not want to overstate our assets or understate the liabilities, right? So on the assets, every year we will be depreciating those assets, right? We will be depreciating. But you know that in accounting, there is a certain time that maybe things might change when people could revalue their buildings, revalue their lands, right? So now, valuation is very important. Valuation is very important. So that's why even people have challenges with if it's number 13, the fair value, right? So we will talk about that. But I want to talk about impairment of assets, where we say there is certain time that you will see like the indicators that this asset I think is overstated. You understand? Imagine, for example, you purchased a motor vehicle, maybe it's not a new one though, maybe you purchased that motor vehicle, there is a certain amount that you paid, and you believe that that motor vehicle, it will be working properly, maybe in terms of mileage, not that much. So you have high expectations that you are going to benefit that much, right? And you paid a certain amount. Then you start using that motor vehicle, you start using that motor vehicle. Then you're now seeing more problems than what you expected. So you end up seeing that I think I paid more than the value of the motor vehicle. So in that case, we'll be saying that maybe the asset was overstated, the price that was given, the price that was charged there, you paid more than necessary. So it was overstated. So there are certain times then you might see that these assets are overstated in the books of accounts. They have to be impaired. Like for example, that motor vehicle, maybe it's worth 50,000, but when in the books of accounts we are saying we have a motor vehicle which is worth 50,000. But maybe if we want to sell it, people won't be prepared to pay 50. Maybe people are prepared to are willing to pay 30,000. So if they're willing to pay 30,000, but your books are saying that it's 50, we might want to compare with the fair value. You understand? So if the fair value is that lower, or the benefits that you expect to get from the motor vehicle even doesn't reach 50,000, it will be clear that the asset is overstated in the books. So what is the objective of IAS 36 impairment of assets? The objective of IAS 36 is to ensure that assets are not overvalued in the statement of financial position, that assets are not overvalued in the financial statements. So we don't want to overstate assets. We want to make sure that the financial statements will keep on showing a true and fair view. Now that we are saying they have to be prepared in all material respects in accordance with the international financial reporting standards. That's what we are saying. So that's the objective. So if you want to value correctly, you have to consider what we call the recoverable amount. What is the recoverable amount? That's the true economic value of an asset, right? That's the recoverable amount. So when do you review for impairment? If you see indicators of impairment, you can review for the impairment. Like for example, there can be internal indicators, there can be external indicators. I gave you an example of motor vehicle, that was an internal indicator. Like for example, there is adverse performance on that asset. Yes, the way it is performing, that is not the way you expected, right? Maybe it's a machine. It keeps on, you repair it from time to time, so many times than expected. And also we can talk about physical damage of an asset, we can talk about obsolescence. If the asset is out of date, therefore it's overvalued. Yes, you give a certain value on that asset, then maybe other items that are being produced or that are being introduced into the market that are new, that are in fashion. So you end up seeing that your asset had a certain value. So that value, you have to reduce it because it's no longer worth that amount. If the asset is out of date, if the asset is out of fashion or obsolescence, then you must reduce the value. Those are the indicators of impairment, obsolescence, physical damage, that is deterioration that we're talking about, adverse performance. And there are also external indicators that you can see outside the organization. For example, outside, there might be fall in prices of an asset. Like for example, you had valued your building, but outside there, maybe the material is not cheap. The price of, I'm talking about the material that is used to build is not cheap. Maybe those buildings, new buildings, they are no longer high. The prices are no longer high. There's fall in the market price. So if you see those kind of things, then it's a sign that you have to reduce your asset. So if the asset is overvalued, you have to reduce. So those are some of the external indicators, even increase in the interest rates. So now, when you see the indicators of impairment, you have to review the asset that you have so that it will not be overvalued in the books of accounts, so that the books will keep on showing in true and fair view. So how do you do that? So we said that you consider the recoverable amount. What is the recoverable amount? Recoverable amount is what? Is the true economic value of the asset. And how do you get it? We say it is the higher of two things. It is the higher of fair value less cost of disposal and the value in use. So you compare these two. Whichever is greater, that's the recoverable amount. So recoverable amount, we are saying how much do we expect to recover from this asset? That's the value of the asset. Like fair value less cost of disposal. What is the fair value? What is fair value? According to IFRS 18, fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. How much do you expect to receive if you sell that asset? Okay, we can say recoverable amount. Let's say recoverable amount, we have a recoverable amount of 10,000. Like the fair value, right? So let's say the fair value is 10,000. Less cost of disposal, maybe 500. So that means we have 9,500. That's the fair value. So we'll be saying if we sell the asset, we will get 9,500. Then we will compare it with the value in use. What is the value in use? We are talking about the value. Now we are no longer saying if we sell the asset, how much do we get? If we sell the asset, we'll get 9.5, that's the fair value. But if we use the asset, that's the fair value. If we use it, how much do you expect to get? Remember, an asset generates economic benefits. So we are talking about the cash inflows into the organization. But those cash inflows, they have to be discounted to present value. So we're saying the present value of future cash flows. So for example, you might expect to use that asset over a period of 3 years or 5 years. Then you sum up all those cash inflows that you expect to get, but they have to be discounted to present value. Maybe for argument's sake, let's say the cash inflows have a total of 8,000. The fair value, that's 9.5. If you compare to the two, the maximum amount that you can get from that asset, that would be 9.5. So that would be the recoverable amount. Then, when you see that you now have your recoverable amount, you then compare it with the carrying amount. So the carrying amount, let's say the carrying amount is 10,000. So are you saying that in your books are showing that you have assets of 10,000, but the maximum amount that you can recover is 9.5? So that means the assets have been overvalued. So you then reduce them so that they will be valued at the recoverable. You reduce it by the difference, like by 500, 10,000 because of 9.5. So that amount that you reduce it with, that will be the impairment of assets. So that's impairment IAS 36. So the impairment loss will then be recognized to the statement of profit or loss. Then on that impairment, which you recognize on profit or loss, in the financial position, remember the assets have to be reduced by the impairment loss. So if it is the total that is covering all assets, like all non-current assets, you have to split it, you have to apportion. So when you apportion the impairment loss, just know that we first impair to the damaged asset, because if we have an asset that is damaged, it's clear that it has to be reduced in value. And also, if we have goodwill, yes, when I see assets that are overvalued, I start to suspect that there is goodwill, which is intangible asset, because it's not that easy to value goodwill. Most people, they tend to overvalue. So you reduce the goodwill by the full amount, then the remaining will be apportioned to the remaining non-current asset. I said it will be apportioned to the remaining non-current. I didn't say current. Why? We don't impair current assets. We don't impair monetary assets. That's how you apportion it. That's International Accounting Standard number 36, impairment of assets.